You've used it 100 times, maybe 1,000. You open the app, watch a car icon crawl across a map, and step into a stranger's Honda without a second thought. You think you understand the business. Someone needed a ride, someone else had a car, Uber sat in the middle and took a cut. Simple. It is not simple, and the version of Uber you think you understand hasn't existed for years. Since 2010, Uber has facilitated something in the neighborhood of 72 billion rides and delivery orders. Not 72,000, 72 billion. In 2025 alone, the company processed just over 13.5 billion trips, a 20% increase from the year before. It did all of this while owning almost no cars, employing almost no drivers, and carrying almost none of the physical risk of moving a human being from one place to another. A company with barely any hard assets became one of the most powerful pricing authorities on Earth. That should bother you a little. It's worth asking, how? Start with what you assume Uber sells, a ride, matched by an app, priced by a formula everyone can see. That's the toll booth model, a fixed, transparent cut sitting between two honest parties. It's a comforting picture. It's also wrong, and it's wrong in a way that matters more than it sounds.
What Uber actually runs is two separate pricing decisions made independently in real time by the same algorithm for the same trip. One decision sets what you pay as a rider. A completely different decision sets what the driver gets paid to accept your trip. These numbers are not mirror images of each other. They're not required to be. Uber decides both sides of the transaction simultaneously, and it is the only party in the room who can see both numbers at once. The rider doesn't see the driver's payout. The driver doesn't see the rider's fare. Uber sees the whole board, and it is the one setting prices on both sides of it at the same time. That's not matchmaking, that's authorship. Most two-sided marketplaces set a price on one side and let the other side respond to it. eBay doesn't tell sellers what buyers will pay. Airbnb doesn't tell hosts what a stay is worth. Uber tells both. That kind of control isn't something you build in a weekend. It's something you buy, and Uber bought it with a level of financial recklessness that, in hindsight, wasn't reckless at all. Rewind to the company's early years. Uber didn't win riders and drivers by being better, it won them by being cheaper than the business could actually sustain, on purpose, for a very long time. In its first 6 months alone, the company burned through close to $1 million chasing growth over margin. That pattern didn't stop after 6 months. It continued for over a decade at global scale in city after city on multiple continents at once. Before its 2019 IPO, Uber had raised more than $24 billion in venture and private equity funding, including roughly $9.3 billion from SoftBank's Vision Fund alone, with additional backing from Saudi Arabia's sovereign wealth fund. That capital didn't go toward better engineering. It went toward keeping fares artificially low and driver incentives artificially high in market after market for as long as it took to make Uber the only option worth using. The company was losing money by design. Cumulative operating losses between 2014 and 2022 added up to roughly $31.5 billion, a number so large it's almost abstract. $31.5 billion is not a rounding error or a bad quarter. It is a strategy, executed patiently for over a decade. Every dollar of it was spent buying something that doesn't show up cleanly on a balance sheet: density. Enough riders in a city that drivers never wait long for a fare. Enough drivers in a city that riders never wait long for a car. Once that density exists, the platform becomes self-reinforcing. More drivers means faster pickups. Faster pickups mean more riders. More riders mean more work for drivers, and the loop feeds itself. Once density doesn't exist, none of that happens. The platform is just an app nobody opens, sitting next to a driver nobody hires. Which brings us to the part of this story most people have never heard because the losing side doesn't get to write the history. Sidecar launched in 2012, 2 years after Uber, and by most accounts, it was the more innovative product. It was the first app to show riders their price before they booked. It pioneered shared rides and driver directions, features that competitors later copied wholesale.
Its own founder later admitted the company out-innovated Uber, but still failed to win the market. The reason wasn't the product, it was the math. Over its lifetime, Sidecar raised about $35 million. Uber, over the same period, raised roughly $6.6 billion. That is not a competitive gap. That is a different sport being played on the same field. Sidecar's founder eventually concluded that the American ride-hailing market only had room for two well-capitalized companies, and his wasn't one of them. Sidecar shut down at the end of 2015 and sold its remaining assets to General Motors. 3 years later, the company's legal successor sued Uber, alleging its executives had directed fake ride requests onto Sidecar's platform to overwhelm its drivers and sabotage the very liquidity it was trying to build. Whether or not that specific allegation holds up in court, the underlying claim is not really in dispute. Uber fought this war with every dollar and every tactic it had. Juno tried a different pitch entirely. Instead of competing on price, it competed on fairness. Lower commissions, in-app tipping, even a plan to give drivers equity in the company itself. It positioned itself as the ethical alternative, the anti-Uber, built by people who believed the industry could work without grinding down the people doing the actual driving. It raised roughly $30 million doing it. Uber, meanwhile, kept deploying capital at a scale no competitor could match, absorbing losses in market after market until rivals ran out of runway to keep fighting. Juno eventually pulled out of New York, unable to compete against larger companies, with city regulators noting at the time that fewer competitors could give Uber and Lyft more room to raise prices freely. Some of Juno's own drivers later filed complaints, alleging they'd been promised equity that evaporated once the company was folded into a corporate travel specialist called Get. The lesson from both companies is the same lesson, told twice in two different keys. Being first didn't matter. Being more innovative didn't matter. Being more ethical didn't matter. What mattered was who could keep losing money the longest, because in a two-sided marketplace, whoever survives the subsidy war owns the liquidity, and the liquidity is the actual product being sold, not the app, the network sitting underneath it. So Uber won the war for density. What does that victory actually look like on a single ride once the war is over and the pricing algorithm is fully in control? Take a $100 fare and follow the money. Based on independent analysis of Uber's own filings, the largest single share, somewhere around $70, goes to the driver after fees, tolls, and commissions are already factored in. A meaningful slice goes toward promotional spending, rider discounts, driver bonuses, referral incentives designed to keep both sides of the marketplace engaged even now that the war is largely won. Another slice covers safety programs, insurance, and regulatory compliance, and this is worth slowing down for because it's one of the least understood levers in the entire business. In many markets, Uber doesn't buy commercial insurance from an outside carrier, it self-insures. Picture the difference. Instead of writing a check to an insurance company every month and losing that money whether or not a claim ever happens, Uber sets that same money aside in its own account. It stays Uber's money, earning Uber returns until and unless a claim actually comes due. A cost center quietly becomes a savings account. What's left over after all of that, roughly $8 by this estimate, is Uber's net contribution margin on the ride. $8 doesn't sound like much, but multiply it across 13.5 billion trips a year, and $8 becomes the foundation of a company generating tens of billions in bookings. Small margins repeated at planetary scale are how this business actually works. That's the story the math tells you at first glance. It feels almost modest, almost reasonable. And that's exactly where it gets complicated, because that isn't the only story being told about where the money goes. Uber's own public position, stated in company communications, puts its worldwide take rate after insurance and other third-party costs at around 21%. That's Uber's number, from Uber, about Uber. Independent researchers looking at individual driver trip histories tell a very different story. Analysis built from real driver receipts, tracked trip by trip over years, found an effective take rate closer to 42%, nearly double Uber's own figure.
up from around 32% before the company shifted to what it calls upfront pricing. Two credible parties describing the exact same company, landing on numbers that don't remotely agree. Both figures can be technically defensible. It depends entirely on what you count, whether insurance is included or excluded, whether you're measuring gross bookings or net revenue, whether pass-through costs get treated as Uber's money or the driver's. And that's the uncomfortable part. Uber's public filings disclose exactly enough to satisfy regulators, and not one sentence more. One researcher who spent months reconstructing driver economics from raw trip data described the company's disclosures as carefully built to satisfy reporting requirements without revealing anything real about how the business actually functions. When the definition of a basic number is this contested, the ambiguity itself starts to look less like an accident and more like a design choice, because ambiguity is only expensive to the side that has to prove something. It costs the company that controls the data nothing at all.
Somewhere in a car right now, a driver is looking at a number on their phone that they didn't set, can't audit, and have no way of comparing against what the rider next to them actually paid. That's not a side effect of the model, it is the model. Whichever number is closer to the truth, one thing in this story isn't in dispute. The gap between what riders pay and what drivers earn has been growing for years. And that growth is not incidental. It's the entire explanation for how a company that lost $31.5 billion became one of the most profitable platforms on the internet. Here's the mechanism. Over roughly 6 years, Uber's share of every fare climbed from around 20% to around 35%. Driver pay rose over the same period too, but at only about half that rate. That is not efficiency. Nobody invented a cheaper way to drive a car, a faster route through traffic, or a smarter dispatch algorithm that magically produced more value out of thin air. What happened is simpler and less flattering. Uber repriced a marketplace it had already spent a decade buying and kept a larger share of the same rides it was already running. The results speak for themselves once you know what produced them. In 2022, Uber posted a net loss of over $9 billion. 1 year later, in 2023, the company reported its first full year of net profit, $1.88 billion, on more than $37 billion in revenue. By the end of 2025, the numbers had compounded further still. Fourth quarter platform bookings reached $54.1 billion, up 22% year over year. Full year 2025 bookings totaled $193 billion. Revenue reached just over $52 billion, and free cash flow for the year hit $10 billion, enough to support a $20 billion stock buyback. Operating income for the year came to $5.6 billion, nearly double the year before. 14 years of losses became, almost overnight by corporate standards, one of the most reliable cash machines in the technology industry. Not because Uber got smarter about running its business, because it finally started charging what its dominance would allow. But repricing existing rides wasn't the only lever Uber pulled. Once it had tens of millions of people opening the app every week, it discovered something every dominant platform eventually discovers. Attention itself is worth selling. Uber's advertising division, launched quietly in October 2022, crossed a $2 billion annualized run rate by the end of 2025, growing more than 50% year over year. Brands now pay Uber to reach you at the exact moment you're already deciding what to eat or where to go. Layered on top of that is Uber One, a subscription membership that behaves less like a taxi perk and more like Amazon Prime. By early 2026, it had grown to 50 million members who account for more than half of all bookings on the platform and spend roughly 3 times as much as non-members. The program had already reached 46 million members by the end of 2025, up from 30 million just 8 months earlier. A subscriber locked into a recurring membership spending 3 times as much is a completely different economic animal than a one-off rider comparing prices between apps. Delivery, in particular, is now generating close to the same transaction volume as mobility itself, which means the marketplace pricing playbook that worked on rides is now running simultaneously across food, groceries, retail, and freight. Now the part of the moat almost nobody talks about, because it doesn't look like a business decision. It looks like a civics lesson. In 2020, facing a California law that would have forced it to classify drivers as employees, Uber helped fund a $205 million ballot campaign for Proposition 22, which carved app-based drivers out of that law and let companies keep classifying them as contractors. It passed with 58% of the vote. California's Supreme Court unanimously upheld it in 2024. Drivers' groups are still fighting it. Lawsuits allege Uber hasn't honored the appeals process the measure promised, and a separate case covering the years before Prop 22 has put the company in settlement talks over what could be billions in back pay. But the core structure has held. A company that started by outspending rivals on rides ended up outspending them on democracy itself. And that $200 million bet has paid dividends every year since. So, could you build this? Could someone actually launch a better version of Uber? Technically, sure. The app isn't the hard part. What's genuinely hard is the part nobody puts in the pitch deck, buying the liquidity and then defending the legal structure that makes the liquidity affordable. Remember Sidecar's $35 million against Uber's $6.6 billion. That gap, nearly 200 times, is the real price of admission before you've spent $1 on ballot campaigns, insurance frameworks, or city-by-city permitting fights. Uber currently holds somewhere between 68 and 76% of observed U.S. rideshare spending, a share that has been remarkably stable for years. That kind of durable dominance isn't an accident of timing. It's what a fully matured, legally fortified, subscription-reinforced network looks like once the war is over and the winner has started collecting. None of that means competition is impossible. It means head-on competition on Uber's exact terms is close to impossible. Didi in China, Grab across Southeast Asia, Ola in India, none of them beat Uber by outcapitalizing it globally. They won in specific geographies where local relationships, local regulation, or local capital gave them an edge Uber's war chest couldn't bypass. That's the real playbook. Not a better app, but a fight Uber has no interest in having. A driver-owned cooperative that trades growth speed for loyalty, a niche too small for a subsidy war to bother with, a region where local relationships matter more than global capital. The lesson from Sidecar and Juno isn't don't compete, it's don't compete on the terms Uber already won, funded, and voted into law. And here's the part that changes the calculation going forward. The company that spent 14 years and $32 billion perfecting how to price human beings against each other, and another $200 million making sure the law would let it, is now quietly building the thing that could make the human part irrelevant. Through its partnership with Waymo, Uber has helped dispatch roughly 100 fully driverless vehicles in Austin within about 4 months of the partnership beginning, with early data showing Austin and Atlanta among the fastest-growing markets in Uber's entire U.S. network. By early 2026, autonomous trip volume on the platform had grown roughly tenfold in a single quarter. Uber doesn't own those vehicles either. It's doing to autonomous fleets exactly what it did to human drivers a decade ago. Sitting in the middle, setting the price, owning none of the risk. For riders, the trip looks identical. For Uber, it removes the largest cost, the largest legal liability, and eventually the entire Prop 22 question, while the pricing engine above it stays exactly the same. The moat isn't disappearing, it's molting. So when you ask whether someone could build a better Uber, you're asking the wrong question. It was never about the app, the driver experience, or the surge algorithm. It was about whether you're willing to lose $31.5 billion on purpose, spend a fortune rewriting the law in your favor, and buy something no balance sheet lists as an asset. The simple fact that when someone needs a ride, your app is the only one worth opening. The next time that car pulls up outside your building, you'll still tap the same button you always have, but look a little closer at what's actually idling at the curb. It isn't a taxi. It's 14 years of engineered losses, $200 million of rewritten law, and a pricing algorithm patient enough to wait for all of it to compound, now quietly learning to drive itself.